Good day to everyone. My name is Nur Ashira Adira binti Nordin with the number matrix of 286333. So today I will be explaining about the financial instrument in international trade, which is the banker's acceptance. So banker's acceptance plays a significant role in providing financial assurance and facilitating smooth transactions between exporters and importers. So, a banker's acceptance is a temporary financial tool provided by a bank. It represents a commitment from a financial institution to pay a specified sum on a predetermined future date. So, this dual purposes instrument safeguard exporters from non-payment risk and allow importers to defer settlement, serving as a temporary financial solution. So there are few distinctive characteristic to banker's acceptance. Originating from a customer's drawing on the bank, this instrument cater a various needs like export, import, domestic sales, or purchaser sales. With tenors ranging to 30 days until to 365 days, they are issued at a discount and redeemed at par upon maturity. The origins of bankers' acceptance can be dated back in the 19th century when merchants engaged in international trade were on the lookout for more reliable and efficient payment methods. The demand for security led to the emergence of time drafts, written orders for payment at a future date. So as international trade expanded, banks found themselves playing increasingly a important role. So trusted financial institutions stepped into the facilitate and secure transaction. They began accepting and guaranteeing the payment of time drafts on behalf of their clients, and they provide a crucial level of assurance to both buyers and sellers. Over time, the use of bankers' acceptance becomes standardized, and they gain acceptance within international trade circles. The involvement of banks in accepting and guaranteeing payment has transformed time drafts into more secure form, where we now know as a banker's acceptance. And the growing popularity of bankers' acceptance has led to the creation of secondary market for these instruments. Investors actively started trading them, contributing to market liquidity and allowing financial institutions to effectively manage their short-term funding terms. So next, we are going to talk about the purpose of bankers' acceptance. So there are two purposes, which is as an investment tool and as a financing tool. So let's first talk about the how bankers' acceptance serve as a reliable investment tool. So investors are drawn to bankers' acceptance for their safety, liquidity, and attractive futures. The involvement of bank adds credibility, making them a secure investment option. So it is issued at a discount and redeemed at par, and bankers' acceptance offer a defined and predictable yield, and it makes them appealing for those seeking short-term returns. So, as a financing tool in international trade, uh, exporters they are offered bankers' acceptance as a robust solution to ensure timely and guaranteed payment for goods sold internationally. By presenting the time draft to the importer's bank, which transform it into a banker's acceptance upon acceptance, exporters mitigate the risk associated with cross-border transaction. There are various parties who are included in the banker's acceptance, which each of them have their own rights and responsibilities. So the first in the lineup is the initiator, which is also the seller or exporter. It is also known as the drawer. So the drawer holds the right to create the banker's acceptance, making trade agreements possible. And their responsibility lies in drafting and presenting the acceptance to a bank for approval, setting the financial process in motion. So next, we have the drawee, typically a financial institution. So this entity accepts the banker's acceptance and they commit to pay the specified amount on the maturity date. So the drawee's rights include the crucial ability to accept or reject the draft and the responsibility of providing a guarantee of payment upon acceptance. And they may also negotiate the acceptance with the drawer, influencing transaction terms. Moving on to the holder, they are known also as the payer of the banker's acceptance. The holder holds the right to receive payment on the agreed upon maturity date, and they can choose to hold the accepted banker's acceptance until maturity or sell it in the secondary market for liquidity. So the holder's rights are integral to ensuring a secure and efficient financial transactions. Now, let's talk about the secondary market investors. So these are individuals or institutions engaging in purchase and sales of bankers' acceptance. Their rights extend to acquiring the instrument for potential profits. However, they bear the responsibility of carefully considering the creditworthiness of the accepting bank to mitigate risks associated with their investment. Each of the participants have their own risks and rewards in bankers' acceptance. So let's begin with the drawer. The rewards for the drawer come in the form of a streamlined trade process facilitated by bankers' acceptance. And this enhances the drawer's credibility in trade transactions. However, there are inherent risks, including credit risks associated with the accepting bank and susceptibility to market fluctuations. So moving on to the banks as drawees, they enjoy rewards in the form of fee income and strengthen customer relationship by accepting and guaranteeing payments on bankers' acceptance. Yet, these institutions face credit risk and interest rate risk, influencing their financial health and reputation. Now, let's talk about the holders of bankers' acceptance. They experience rewards in the form of payment assurance and liquidity options through the secondary market. However, default risk from the accepting bank and exposure to market fluctuations pose potential risk, necessitating a careful assessment of creditworthiness. Enter the investors engaging in the purchase and sales of bankers' acceptance in the secondary market. They enjoy profit opportunities and portfolio diversification. Yet, credit risk tied to the accepting bank and market risk from interest rate fluctuations introduce challenges to require astute risk management. Moving on, I am going to explain about the pricing mechanism of bankers' acceptance. So, bankers' acceptance are truly versatile instruments. They serve both as a reliable financing tool for international trade and attractive investment option. Now, let's dive into a simple example to illustrate the pricing mechanism for both scenarios. So, imagine a scenario where the face value of a banker's acceptance is $100,000 with a discount rate of 2.5% per annum and a time of maturity date of 45 days. So, applying the pricing formula, we get a discount settlement amount of approximately $96,861.73. This represents the present value of the face value discounted at a rate of 2.5% per annum for the 45-day period until maturity. Now, consider a different use of bankers' acceptance as a financing tool. Here, the face value is $150,000 and the discount rate is 3% per annum, and the time to maturity is 60 days. Using the same pricing formula, we get a discounted settlement amount of approximately $143.14. This represents the present value of the face value discounted at a rate of 3% per annum for the 60-day period until maturity. So in both examples, notice that the banker's acceptance operates similarly for both investment and financing tool, and the discounted price is calculated based on the face value, discount rate, and time to maturity. The difference lies in the specific parameters such as the discount rate and time to maturity, reflecting the unique requirements of either investment or financing purposes. So the primary differences between these two scenarios lies in the objective and preferences of investors or financiers. And for investment, a lower discount rate is used, reflecting a lower cost of funds and a desire of a higher yield. In contrast, for financing, a higher discount rate is applied. Consider the potential risk and costs associated with providing funds and for a longer duration. Now, let's talk about how bankers' acceptance are traded. So, in the world of bankers' acceptance, the bid-ask spread takes center stage in determining the trading strategy. This spread is essentially the difference between the buying or bid and selling ask price, a key factor influencing trading decisions. When the bid rate is higher than the ask rate, it creates an inverted or reverse spread. So this scenario implies that buyers are willing to pay a higher price and sellers are quoting a lower price, shaping a unique trading dynamic. So now let's talk about the trading strategy. In a conventional approach, investors typically aim to buy low and sell high to make a profit. However, in the case of an inverted bid-ask spread, the strategy is reversed. Investors following the buy high, sell low approach look to purchase at a higher bid rate and sell at a lower ask rate. This might seem counterintuitive, but it can be profitable in certain market conditions. So for an example, using a banker's acceptance with a face value of 100,000 and a time to maturity dates of 60 days. The buying price calculated based on the bid rate is approximately 99,269 and 26 cents. So the selling price determined by the offer rate is around 99,297 and 72 cents. So in this unconventional trading scenario, investors buy a banker's acceptance at a higher bid rate, spending 99,293.26 cents and subsequently sell it at a lower offer rate, receiving 99,297 and 72 cents. It showcases how the bid-ask spread can lead to profitable opportunities and challenging traditional trading forms. So there are secondary market in bankers' acceptance. Bankers' acceptance essentially in international trade and short-term financing don't just serve as a primary transactions. They actively participate in secondary market, which plays a important role in enhancing their overall efficiency and attractiveness as financial instruments. And the secondary market for bankers' acceptance is marked by dynamic trading activities, involve a diverse range of participants. Investors, financial institutions, exporters, and importers engage in buying and selling bankers' acceptance. They create a vibrant marketplace that responds to the evolving needs to the financial landscape. So one primary advantage of the secondary market is its ability to provide liquidity. Participants can readily buy or sell bankers' acceptance based on their financial requirements, contributing to a more agile and responsive financial ecosystem. So, brokerage firms and financial institutions are crucial intermediaries in the secondary market. They facilitate smooth transaction by connecting buyers and sellers, ensuring a seamless exchange of bankers' acceptance. These intermediaries play a key role in matching supply and demand and contribute to the overall functionality and effectiveness of the secondary market. And various entities participate in the secondary market. They reflect a diversity and market dynamics. Institutional investors, money market funds, and other entities seeking secure short-term investment contribute to the depth and breadth of the market. One of the primary ways that we can engage to the bankers' acceptance is through banks. So for exporters, this involves working closely with their banks to create and facilitate the acceptance process. The bank's involvement adds credibility to the payment mechanism to ensure and secure efficient transaction. Similarly, investors or importers seeking short-term financing can approach their banks to inquire about the availability of bankers' acceptance as part of the financial service offered. So another avenue is through money market funds. So these funds designed to provide liquidity and stability often include bankers' acceptance in their portfolios. So this inclusion allows investors to gain exposure to bankers' acceptance as part of their diversified investment strategy. The secondary market plays a significant role in assessing bankers' acceptance, and brokerage firms and financial institutions act as key intermediaries. Investors can engage with these entities to access the secondary market and participate in the buying and selling of bankers' acceptance. And the expertise of financial brokers facilitates seamless transactions within the dynamic market. Lastly, the regulatory landscape of bankers' acceptance and understanding the guidelines and agencies that ensure their proper issuance, acceptance, and trading. So, bankers' acceptance regulations are the legal framework established by each jurisdiction. This framework defines the legal rights and obligations of parties involved in bankers' acceptance transactions, and they create a solid foundation for their users. Banking regulations are important to guide the financial institutions in the issuance of acceptance of bankers' acceptance. So these rules ensure compliance with prudent financial practices, safeguarding the interests of both banks and their clients. The international nature of bankers' acceptance brings them under guidelines from international trade and financial organizations. Bodies like the International Chamber of Commerce (ICC) may provide standardized practice promoting consistency in bankers' acceptance transactions across border. Central banks also plays a important role in the financial regulation, may oversee bankers' acceptance and ensuring the stability and soundness of the financial markets where bankers' acceptance are active, particularly in the issuance of acceptance process. And lastly, the security regulators also involved in the bankers' acceptance, and they share characteristic with securities, focusing on disclosure, transparency, and fair trading practices, especially in the context of the secondary market trading.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nurul Fatia binti Dahlan and my metric number is 287519. So today I will present about mudharabah as instrument that I choose for this group assignment. Definition of mudharabah. Mudharabah is a financial partnership arrangement in Islamic finance. Profit generated from the venture and share between the parties according to pre-agreed ratio, while losses are borne solely by the capital provided. Next, the purpose of mudharabah. The first one is mudharabah emphasizes sharing both profit and losses between the investor and the entrepreneur. This encourages a fair distribution of gains and ensures that both parties are invested in the success of the venture. The second one is mudharabah is a root in Islamic finance principle that strictly prohibit the payment of or receipt of interest known as riba. Instead of lending money for interest, mudharabah promotes a partnership structure aligning with Sharia compliance financial practice. Next, in a mudharabah arrangement, effective risk management is integral to the success of the venture, and the role of mudarib, who manage the business operation, is crucial in this regards. Mudharabah contributes to the equitable distribution of wealth by allowing investors to share in the profits generated by entrepreneurs' activities. Next, how mudharabah is created. Mudharabah is established through a mutual agreement between two parties, the Rabul Mal, capital provider, and the mudarib, entrepreneur or manager. The terms of the partnership, including the investment amount, profit sharing ratio, and business activities, are outlined in a formal contract. This contract specifies the roles, responsibilities, and distribution of profit and losses between the two parties. Parties that involved in mudharabah is Rabul Mal, which is a capital provider, and another one is the mudarib. The responsibilities of each parties. For Rabul Mal, these parties contribute the capital for the business venture and share in the profit based on the pre-agreed ratio. While mudarib, this party contributes labor, expertises, and manage to day-to-day operation of the business. Next is pricing mechanism of mudharabah. The first one is fixed ratio. In this approach, the profit sharing ratio is fixed and agreed upon in advance. For example, the Rabul Mal may receive 70% of the profits while the mudarib receives 30%. The second one is sliding scale. The profit sharing ratio can be structured on a sliding scale where distribution varies based on the level of profits generated. For instance, the moderate might receive a higher percentage of profit if the business performs well, providing an incentive for better performance. Lastly, negotiation sharing. The parties involved may negotiate the profit sharing ratio based on the specific circumstances of the business venture. This allows for flexibility and customization according to the nature of the project and the contribution of each party. So next, let's move to how and where to access Mudharaba One Avenue. One avenue for accessing Mudharaba is through direct consultation with Islamic financial advisor or relationship manager within this institution. These professionals guide potential investors through the intricacies of business Mudharaba, explaining the profit sharing mechanism, associated risks, and potential benefits. Additionally, as technology advances, online platforms have become increasingly prevalent in the Islamic finance space. Some of Islamic financial institutions provide online portal or mobile application that allow individuals to explore, understand, and initiate Mudharaba investment remotely. Lastly, traditional banking channels also remain relevant for accessing Mudharaba-based investment product. Investor can visit local branch of Islamic banks, engage in face-to-face discussions with banking representative, and complete the necessary documentation to formalize their participation in Mudharaba partnership. Next, how Mudharaba used in a bank treasury operation is capital contribution. The bank acting as the investor, Robulman, provide the capital for investment. This capital is used by the entrepreneur, Mudarib, to conduct business activities. Entrepreneurial and management. The Mudarib who possesses business expertise is responsible for managing the entrepreneurial venture, this including in decision-making, day-to-day operations, and strategic planning. Next, Sharia compliance. Mudharaba adheres to Sharia principle, ensuring that the investment and profit-sharing arrangement comply with the Islamic finance guidelines. Interest-free transaction and ethical business practices are fundamental to Mudharaba. Last one is limited liability. The liability of the Mudarib is limited to their initial investment. This means that if losses occur, the Mudarib does not need to cover losses beyond their contributed capital. So what is the official guideline for Mudaraba? The guidelines set by BNM and Sharia supervisor both cover various critical aspects of Mudaraba transaction. Second, the key legislative act that provide the legal basis for Islamic finance, including Mudharaba, is the Islamic Financial Service Act 2013. And the last one is the Sharia Advisor Council, established under IFSA, is responsible for ensuring the Sharia compliance for Islamic financial product, including Mudharaba. Last for my part is regulating agency of Mudharaba. First, regulatory oversight. Bank Negara Malaysia, the Central Bank of Malaysia, oversees Islamic finance activity and enforce regulations set out in IFSA. Second, Islamic financial institution, Islamic banks, and financial institutions in Malaysia operate under the regulatory framework provided by IFSA. Third, documentations and agreement Mudharaba transaction in Malaysia involve a formal agreement between the investor, Robul Mal, and the entrepreneur of fund manager Mudharib. Next, compliance with guidelines. Islamic financial institution ensure compliance with guidelines issued by BNM, incorporating Sharia principles into their Mudharaba products. Last one is continuous regulatory updates. The regulatory framework may evolve over the time with updates and lesson of IFSA and additional get planned by BNM. That's all from me. Thank you. I will pass to the next presenter.
Hi, my name is Itina Suha binti Muhammad Sadi. My number matrix is 285346. I will explain about negotiable instrument of deposit (NID). The definition of an NID is a bank issue financial instrument traded on a secondary market. Its function as deposit certificate with predetermined term. It's popular among high net worth individual and institutional investor. Purpose of creating NID is to enable financial institution to issue negotiable deposit like instrument. It's aimed to attract funds with competitive rates and flexible term. It also provide liquidity and negotiability for investor. It also help in managing liquidity, rising fund and diversity portfolio. Creation of NID is issued by financial institution like bank or development financial institution. It requires regulatory approval from bodies such as Securities Commission or Central Bank. Is structured by the issuing institution with term and condition matching investor preference and market condition. It's also documentation prepared and reviewed by legal counsel. It's also distributed to investor through various channels including institutional investor, brokers, house and direct sale. It's also settlement process involve sending investor funds, pursuing issuing institution and recording insurance information. It's also list on reputable stock exchange or trading platform for enhanced liquidity. A party that's involved in NID is issuer. Issuer is typical a bank or development financial institution drafting or releasing the NID to obtain fee. Second is investor, which is individual, businesses, or institution organization purchasing NID as investment instrument. Next is regulatory bodies such as Security Commission Malaysia (SC) and Bank Negara Malaysia (BNM), overseeing compliance with law and market standard. Next is legal counsel, which is assist issue in adhering to regulatory standard and understanding legal nuances. The last one is optional party, which is financial consultant and underwriter type structure. NID offering, facilitate sale and provide advice on marketing and distribution tactic. Right of party in NID. First is creator or drawer. Is to initiate NID and instruct drawee, usually a bank, to make payment. Next is payee, which is receive payment from drawee as instructor. Next is holder. Holder is they have right in possesses the NID. Holder in dual cost have legal protection in during payment. Next is endorser. Right in sign NID, creating legal right to receive money to endorsee. Next is needy drawee, which is the right to may be asked to make payment if original drawee is ineligible. The last one is acceptor for honor, which is they have right to consent to pay NID for honor of endorser or drawer. Next is responsibility or obligation of party in NID. Maker or drawer has responsibility to initiate NID, ensure accurate drafting and compliance with legal criteria. Next is drawee. Drawee has responsibilities to process such payment, confirm NID legitimacy, follows banking policy and procedure. Next is payee. Payee responsibility or obligation is to follow instruction for fund use, fund report for regulatory or tax purpose. The next is holder. They have responsibility to store NID security, delivery the payment at agreed venue and time. Next is endorser, which is to responsibility is to confer legal right to transfer payment right, ensure legitimacy of endorsement. Next is endorsee, which is they have responsibility to confirm authenticity of endorsement before submitting NID for payment. The last one is needy drawee and acceptor for honor. They have subject to additional responsibility as per NID provisional or and this honor particular. Risk of party in NID transaction, which first is creator or drawer have risk of non-payment if drawee does not honor NID. It have potential harm to reputation. Next is drawee. They have risk in counterparty or from risk of dishonor if funds are insufficient. Next is payee. Payee has risk of dishonor affecting reputation and cash flow. Holder has risk of theft or loss of NID, non-payment if instruments is dishonor. And endorser have risk of default if endorsee fail to meet commitment, potential liability for disobey NID. Acceptor of for honor, they have financial risk if drawer or endorser fail to reimburse for honorary NID, and risk they also have to face risk of non-payment if drawee default. Reward or benefit to party in NID transaction. First is greater drawer. They have reward or benefit to easy access to funding for various needs, improving liquidity and timely fulfillment of obligation. Drawee have benefit on increasing interest income, enhance client interaction and royalty. Payer have benefit in reliable and steady income stream as promised in NID. Holder, the benefit that holder get is investment opportunities with stable yield and low risk, negotiability for liquidity needs. Endorser have a benefit in additional source of income through free income. Endorsee have benefit in ID for financial flexibility, right to receive money as deposit in agreement. Drawee in need have benefit in fee income for providing payment service in case of dishonor. Acceptor of for honor have benefit in strict-handed credibility and reputation. They also have benefit in potential for new commercial opportunity. Pricing mechanism of NID. His have market interest rate with benchmark for NID yield investment for tonners and any premium discount. Next is the tenor or maturity period is longer tenor typically offer higher yield to offset interest rate risk. Next is issues credit risk, which is highest credit quality issue offer lower rate due to lower purchase default risk. The last one is unique feature or term. Callable NID or embedded option may affect pricing of to offset investor risk. Trading machine of NID offers its secondary market is a main venue for NID trading after initial insurance. Next is platform. NID is traded over the counter OTC or list on authorized exchange. Broker's house. Felicity matching of buyer and seller execute trade on behalf of investor. Next is trade type, which is limit orders indicating price or market order indicating desire to buy or sell at going rate. Next is negotiation, which is direct negotiation between buyers and seller for OTC trade. The last one is not the last one, but next is settlement, which is buyer pay agree upon price, seller provide NID within predetermined time frame. Clearing and settlement handled by custodian bank and clearing house to ensure smooth transfer of money and security. Next is regulatory complement, which is disclosure rule enhanced by regulatory authorities for transparency and investor protection. Secondary market for NID. Secondary market exists in Malaysia by buying and selling issue NID. Channels include over-the-counter OTC platform by brokerage firm and financial institution, and recognized stock exchange like Bursa Malaysia. The benefit of secondary market for NID is to offer transparent marketplace with regulated trading process. This also improved the price discovery and liquidity exchange market efficiently and investor confidence. Access to NID can the main source of access to NID is brokerage house, bank and financial institution. Bank and financial institution offer NID product to retail investor through branches or online banking service. Brokerage house is to provide access to NID through transaction on exchange or OTC platform. It also offers online trading platform for conversionist access. Next is wealth manager or financial consultant. It offers advice or and suggestion on NID investment based on risk tolerance and financial objective. Use of negotiable instrument of deposit NID in bank treasury operation. NID are utilized in bank treasury operation to manage balance sheet and liquidity. It also investment options, which is bank allotted excess cash to earn money to earn return by buying NID as in secondary market. Source of funding. Bank will raise money by issuing NID to investor, expanding funding source for lending operation. Next is market trading. Treasury Department trade NID to optimize profit and manage interest rate risk. NID also used as collateral for loans. NID used as collateral for short-term loans in interbank market to exchange liquidity management. Regulatory guideline for NID. First is oversight, which is Securities Commission Malaysia SC regulated NID under Capital Market and Service Act 2007. Next is investor safety. SC established guideline and procedures for issuing, offering, and trading NID to maintain investor safety and market integrity and transparency. NID also have Sharia compliance. Sharia Advisory Council set standard for NID issued by Islamic bank to ensure adherence to Islamic financial term. Overall, SC regulatory framework provides standard and guideline for controlling NID insurance and trading, enhancing investor protection and market integrity. Regulating agency for NID. Security Commercial Malaysia and Bank Negara Malaysia are the main regulatory bodies in Malaysia for monitoring NID insurance and trading. SC primary regulator overseeing the nation capital market and establish guideline, rule and standard for NID insurance offering and trading. It also control various facets of NID operation to ensure transparency, market integrity and investor safety. SC roles include setting disclosure requirement for issuer, eligibility requirement for investor, reporting standard and compliance requirement for financial institutions and intermediaries. SC also conducts surveillance and enforcement to monitor rules compliance and take action against misbehavior or violation in the NID market. Bank Negara Malaysia Central Bank regulated certain NID operation related to financial stability, monetary policy and banking law. Supervised bank and financial organization issuing or trading NID to ensure adherence to prudential rule, risk management, best practice and market conduct. Bank Negara Malaysia responsibilities including evaluating system risk associated with NID transaction, monitoring liquidity and solvency of participating bank, and issuing instrument instruction or guideline for NID market participants, especially in risk management, capital adequacy and liquidity management. Collaboration between regulatory bodies ensure fair, open and effective operation of NID market, supporting overall integrity and stability of Malaysian financial system. That's all from me. I will pass to the next presenter.
Bismillahirrahmanirrahim. Assalamualaikum. I'm Nawal binti Kanti, number matrix 288180. Okay, now I will present about Sell and Buyback Agreement, which is SBBA. SBBA is one of Islamic financial instrument that is almost the same as a repurchase repo agreement, but SBBA is in compliance with Sharia principles. It involves two transactions, firstly SBBA and second is reverse SBBA. Okay, SBBA is an Islamic repurchase agreement repo transaction where one party is the seller of the SBBA Islamic securities at a price that has been agreed to the buyer of SBBA. Then these two parties will make an agreement where the buyer will resell the Islamic security to the previous seller at a future time that has been determined and an agreed price. Okay, next is about the reverse SBBA. Reverse SBBA is an Islamic reverse repurchase agreement transaction where the SBBA buyers buys the Islamic security at an agreed price from the SBBA seller, and after that, the buyer of the SBBA and the seller of the SBBA, they will enter into an agreement in which both of them undertake to sell and the latter to buy back the security at a specified future date and at a mutually agreed upon price. Next is about the purpose. The purpose of SBBA was introduced to increase liquidity in Islamic interbank money market (IIMM) and provide additional channels for IIMM participants to obtain their financing needs. This is because the rapid development of the Islamic banking system necessitates that they need to create additional instruments for IIMM to address future needs and requirements, which is expanded by Islamic banking participants. One way to address the lack of instrument is through the introduction of SBBA. Okay. Furthermore, This SBBA mechanism has been confirmed by the National Sharia Council for Islamic Banking and Takaful Bank Negara Malaysia. Okay, next is who is the party involved. Okay, there are two party that was involved in SBBA. First, we have the seller and the buyer. The seller of SBBA is someone who sells the Islamic security and get cash, while the buyer is someone who buy the Islamic security and pay cash. Okay, usually one of the party is Islamic banking institution, IBI. Okay, next is about what the right of each party. Okay, right of each party is the SBBA seller. They has right to buy back the Islamic securities that have been sold, and the SBBA buyer has the right to resell the Islamic securities to the seller and get cash based on the agreed price. Okay, next is regarding about the obligation of each party. Okay, obligation for the SBBA seller, they must give the Islamic securities to the SBBA buyer after the transaction is completed, and this security will become property of the buyer according to the time specified. Meanwhile, the buyer, they must pay according to what has been agreed and must resell the securities to the original seller and not anyone else at the time and price that has been agreed between them. Transacting parties may conduct SBBA transaction via the money broker or through direct billing. Okay, next is about the risk. Okay, risk that will happen is if one of the parties does not fulfill the promises. So this will have a negative impact on the planning that has been done. An example is that Islamic banking institution has planned and included SBBA to control their money market and also as a requirement for liquidity. But when the buyer does not resell, then it will affect the liquidity requirements for their money market. Okay, the next risk is counterparty risk. Okay, which is one of the parties cannot pay. An example is that the original seller does not have enough money to buy back Islamic securities from the buyer. So it will be a risk for the buyer because they will not get cash within the agreed time. But there is a solution for the risk that occurs if one of the party does not keep the promise. If this happens, the Sharia allows to claim compensation from the party who broke the promise. In this case, both parties, they must include compensation in the agreement made. This is to reduce losses and risks due to breach of promise and others. The compensation can be claimed on the due date. The next is about the benefit for each party. The benefit for seller, they have the ability to raise short-term liquidity. They can get immediate cash. SBBA offers flexibility in financing, also allowing the seller to meet short-term funding needs without compromising long-term investment strategy or having to sell the asset permanently. Okay, next for the buyer. The benefit for the buyer is the buyer receives the Islamic security as collateral during the SBBA transaction, and this will increase the security of transaction. Next is about the procedure. In this procedure, there are two agreements that will be made. Okay, the first agreement is the SBBA seller sells outright Islamic securities to the SBBA buyer at an agreed price and settlement date. While the second agreement, the SBBA buyer promises to sell back the Islamic securities to the SBBA seller, whom shall also promises to buy back the instrument at an agreed price and at a future settlement date. The undertaking made by both the SBBA buyer and SBBA seller to sell and buy back the instrument respectively at the maturity date of the SBBA shall be based on promise. To maintain market integrity and ensure the smooth operation of the IIMM, the parties shall be mindful to perform their obligation as promised. On value date, the SBBA seller may initiate the SBBA transaction where specified securities are sold and transferred to the SBBA buyer for an agreed cash consideration. Ownership of the security shall be transferred to the SBBA buyer upon conclusion of the first agreement on the SBBA. On maturity date, the SBBA buyer shall perform the reversal of the initial SBBA transaction by selling back specified Islamic security transaction to the SBBA seller for an agreed cash consideration as promised. Okay, next is for the secondary market and also the bank treasury operation. Okay, bank also engage in SBBA transaction in the secondary market. They're contributing to market liquidity and also creating additional opportunity for short-term financing or investment. Okay. Next is for the bank treasury operation. This instrument is used for short-term liquidity needs and manage cash flow. For short-term liquidity management, the banks often have fluctuating liquidity needs due to daily operation, customer withdrawal, and other factors. SBBA provides a mechanism for banks to obtain short-term funds without permanently disposing of valuable assets. Other than that, bank may use SBBA to optimize returns on specific asset. By temporarily selling asset through SBBA, they can earn a profit on the sale and later repurchase the asset. And the last is the guidelines and regulating agency. The official guidelines for SBBA is guidance, notes on sale and buyback agreement. This guidance was issued by Bank Negara Malaysia (BNM) on 1st August 2002 to Islamic banking institution.
Assalamualaikum, my name is Siti Noaisha binti Ibrahim. My metric number is 289527. I will continue to the next part, which is tawarruk instruments. For the definitions, tawarruk comes from the Arabic words al-waq or al-waraqah, which refer to minted dirhams or exchangeable silver. Language researchers also only cite variable nouns like al-iraq, which means a rich person, and al-istiraq, a man seeking dirham. Thus, academics come up with the terms tawarruk for people who can get al-wariq or currency. In technical terms, tawarruk consisted of two separate sale and purchase transactions. In practice, tawarruk is a selling transaction in which a buyer buys a commodity from an issuer for deferred payment and then sells it to a third party for cash at a lower price. There are many forms of tawarruk. The first form of tawarruk involves a short-on-cash person buying a commodity on credit to covertly sell it. Second form of tawarruk refers to a person who needs finance, seeks a loan from a financial institution. This individual, mustawriq, may sell a commodity with cash at its market price for a price higher or lower than the market price to get instant cash. The third form of tawarruk is similar to the second, but the trader sells the product to the mustawriq at a greater price due to the deferred payment basis. Next, for the purpose of tawarruk, tawarruk aims to provide instant cash. The reason for this was that Islamic banking lacked a cash option for its customer. Furthermore, a deferred payment transaction refers to an Islamic bank offering a commodity to a customer for cost additional profit. Next, there are several parties involved in tawarruk. First party is the customer, mustawriq, who needs a funding. This entity buys a product on credits and sells it for cash. This customer seeks Sharia compliant borrowing from a bank. The second party is a bank, which also known as a mustawriq's agent. A bank buys goods from a supplier and sells them to customers with deferred payment options. Finally, the supplier is also involved. The supplier provides the commodity to the banks and transfers the ownership according to the Sharia. Next, we move to the right or responsibility of each party involved. Firstly, the customer rights and obligations. Customers can buy and sell the commodity. The consumer can also buy the commodity at the original price and make deferred payment. After purchase, the consumer might sell the item in cash to a third party. However, if the buyer finds a problem in the commodities specified in the purchase and sales agreement, they are entitled to the defect option or qiyar al-aib. Given the defect, the purchaser can terminate the sales and purchase agreement, continue with the change condition, or keep it in place. Secondly, the financial institution responsibility and right as mustawriq's representative. Financial institutions can earn from sales, which are the difference between initial cost and deferred selling price generate profits. They can charge consumer a higher fee later. The financial institution must also identify the contracting parties and, if relevant, the agent's duty on each buy and sell agreement in line with the tawarruk. Other rights and obligations apply to the commodity supplier. This includes delivering the commodity to the financial institutions or its representative. We move to risk to each party. Firstly, the customer. The customer confronts market price risk. The customer may lose money selling commodities when price fall. Selling to a third party at a higher price also may cost the customer. Repayment ability is another customer risk. Then, postponed bank payments require customer to review their finance. Next, the financial institution representative representing Mustawrid also faces liquidity, market, and default risk. The financial institution may face default risk if Mustawrid default on the deferred payment. Thus, financial institution profitability will suffer. On the other hand, market risk occur when a financial institution cannot sell a commodity at the anticipated higher price. Next, benefits to each parties. Firstly, the customer or mustawrid benefits from the commodity either through investment or consumption. After buying the commodity from the financial institutions, which provides a commodity-backed structure, the mustawrid owns and title it. Next, deferred payment assists the mustawrid in delaying commodity payment. The mustawrid also benefits when the financial institution sells the commodity for cash on behalf of the customer, freeing the customer of the financial obligations of its procurement, storage, shipping, and marketing. Next, tawarruk benefits the financial institutions by generating profits. The financial institutions earn recurring revenue from the difference between the initial buy price and the deferred selling price. Financial organizations also benefits from charging prospective consumer a service fee. They may charge client administrative fees or other service charges to facilitate the tawarruk transaction, which can increase their revenue. Next, we move to pricing mechanisms of tawarruk. To illustrate, the mustawrid approached a financial institution for commodity-based funding, which started the pricing process. The seller then sells a commodity for the mustawrid, which deferred payment, where the mustawrid agrees to pay the seller later. The mustawrid then spot transact with the third party, indicating an urgent transaction. The customer then repays the financial institution the initial purchase price and the debt to complete the transaction. Next, as you can see in the illustration above, this is how the tawarruk instruments are traded. Is there any secondary market in tawarruk instruments? Okay, principal transactions are usually involved in tawarruk transaction between the financial institutions and the customer. In contrast, secondary market tawarruk transaction involve tradable instruments or contracts. The financial institutions that supply mustawrid's commodity works as his agent to transfer its right to future customer payments to a third party. These right sales occur on a secondary market where financial institutions trade security representing tawarruk transaction cash flow. Next, tawarruk transactions or instruments are available in Islamic finance in many ways. Potential customers can get funding through tawarruk transaction at Islamic banks and financial institutions. Furthermore, how does tawarruk instrument used in a bank treasury operations? So, financial institution treasury departments must manage risk, asset, liquidity, and liabilities. Tawarruk is a liquidity management transaction that ensure a financial institution's bank treasury has enough cash for its current and future demands. Next, for official guidelines that regulating tawarruk transactions, there are several regulations governing the tawarruk instruments. Generally, tawarruk transactions are governed by Corporate Governance for Development Financial Institutions guidelines. Furthermore, the tawarruk instruments contains guidelines regarding product disclosure and transparency. Finally, regulations pertaining to the impositions of late payment fees on Islamic financial institutions. Meanwhile, for the regulating agencies in tawarruk instruments, tawarruk has dual agency governments. In tawarruk, dual agencies are split. Firstly, wakalah, agency acquisitions of assets, refer to a financial institutions that buy and sell the commodity for the contracting parties. Additionally, muwakil is when one party serves as an agent to buy the item from himself on behalf of other parties and then sell it to a third party on their behalf.